everyone. Welcome to Economic Impact. Today is Feb 11, 2025, and as usual, I am with our chief economist, Stéfane Marion. Stéfane, surprisingly, once again, assets are doing well.
Denis, all the countries that are in the crosshair of the U.S. president or Washington on a tariff war are actually outperforming the S&P 500. But more tellingly, Denis, all asset classes are up this year, so far this year, and as I say, might be surprising to see a stock market behaving so well outside the U.S. on the premise that we understand that there's a global trade war, but whether it will be as punitive as what we think for the global economy is not the baseline scenario at this point in time. So the market is thinking otherwise versus what the president is saying at this point in time.
At this stage, it seems that Europe and Asia are not too concerned.
Exactly. I mean, again, these are the countries that are facing the biggest threat of U.S. traffic, of U.S. tariffs right now, and yet the market is saying it will be too punitive for the U.S. to proceed with a 25%. Doesn't mean there won't be any tariffs, Denis, but 25% tariff will be too punitive on U.S. inflation. Therefore, markets are not buying it right now. I think it's interesting to look at this way, market expectations, but again, let's not be complacent because something might still happen in the next few weeks.
And surprisingly, in Canada, we see up 3.1%, but it's not all sectors. In fact, it's only two.
That's the point, because just the sheer threat of these tariffs is fragilizing the Canadian economy. In case in point, most sectors are not behaving so well year to date, but the sector that's carrying the TSX, actually there's two, technology, but that's a small component of the S&P TSX, but mostly it's the materials sector, up 13% year to date, really enabling the Canadian stock market to outperform the US, for example.
And with the uncertainty, there's gold and there's materials, and golds are new high.
Well, if you're going to look at materials, you cannot not speak to gold prices because we're a big producer, and that's a large chunk of the S&P TSX. And gold price is at a new all-time high in nominal terms, $2,900 or so, US dollars. Adjusted for inflation, you go back more than 50 years, and it's a new all-time high. So basically, some components of financial markets saying, well, we're not so sure about this tariff war, and the way to protect myself is to buy a tangible asset, and one of them would be gold. There's probably still upside for that.
Yeah, in history, gold has been, a safe haven against inflation.
It could be a safe haven against U.S. dollar depreciation, but the U.S. dollar is at a new all-time high. Mm-hmm. But you're absolutely right against inflation. Gold is looking at inflation expectations right now, and this is a poll made at the consumer level and say, Denis, what do you think inflation might be a year from now? It actually has surged more than 100 basis points in the past month or so, and people are saying, it might be 4%. Denis, I'm telling you, if we have 4% inflation, there's no way that the Federal Reserve can ease monetary policy. So this is why gold price is saying, if you want to be aggressive on a tariff war, a global tariff war, we might keep you in check because inflation is going to be higher.
Yeah, at the same time, we have rates pretty high in the state, and the stock market doesn't go down. Then we have that, what we call the first time negative equity premium that we haven't seen for a long period of time, almost 20 years.
Yeah, so if you're an investor, you say, if I'm willing to take the risk to invest in the stock market, there's a premium I'm willing to cope with. But if at some point the equity risk premium turns negative, that means I'm not necessarily compensated to take that type of risk in the stock market, not knowing whether a tariff war will unfold or not, versus what I get to invest in something perceived to be safer, 10-year Treasury yield. This is the first negative equity risk premium in a generation. That's a generation. So this is why the stock market is vulnerable to this global tariff war. This is why we said last month that we don't think 25% is the baseline scenario. We know there will be some tariffs on China right now. There are some. But whether they can be aggressive or Washington can be aggressive remains to be seen without fragilizing the stock market and creating a negative wealth effect for U.S. consumers.
And back in Canada, there's a big concern. Uncertainty is at the highest level that we haven't seen.
The Canadian economy is fragilized, and you're absolutely right. We saw it in some certain industries of the S&P TSX that we showed previously, But at the same time, if you want to put a number on it, if you look at the index of policy, economic policy uncertainty, record high. So it doesn't matter that we've signed free trade agreements with more than 50 countries. Corporations right now don't know how to manage their business plan because we don't know if these tariff threats will unfold or not. Now, we saw this week a 25% tariff on aluminum and steel. That would be a big impact on the Canadian economy, but the tariffs are not to be applied, well, might come into effect on March 4. So we'll see what happens over the next 3 weeks, but clearly you are fragilizing the Canadian economy right now with tariff uncertainty. You don't need to have the tariffs in place. The uncertainty itself is fragilizing the Canadian economy.
Yeah, and investors in those new factories and so on, they're frozen right now. They won't do anything.
You're going to get weak investment and therefore probably weak economic activity in the first half of 2025.
That's why we need the government to be in place and put stuff that will help those industries to invest and keep the economy going, up and working, despite the fact what's going on south of the border.
I think there are discussions on that. Remember when you spoke to interprovincial trade barriers? Now there's more talk about this. People are talking about, energy security is very important for economic sovereignty. So we're saying, a big change. We could actually aspire to policies that will be, positive for the Canadian economy in the second half of 2025. The first half will be shaky, but the second half. In the meantime, what it means, Denis, is that the Bank of Canada is forced to be more aggressive on monetary policy easing, which they mentioned just a week ago when they eased monetary policy.
Yeah, and with that uncertainty, the Loonie, the Canadian dollar, is keep going down.
Well, since the Bank of Canada is saying that, this uncertainty is fragilizing the Canadian economy, so they're opening the door to further rate cuts. Therefore, the interest rate differential is driving the value of the Canadian dollar, which early in February, when we thought that the tariffs would be imposed at the beginning of this month, it's been delayed till March, Canadian dollar went to 147, came back to 143, where we stand right now. But again, you can't forecast an appreciating dollar until we have a better visibility on tariffs or not. But at the same time, having visibility on Canadian policies will be very important to support the currency. And then, you know what? We want to put a positive spin on that. We believe that what's going to happen in the second half this year should be more positive for the Canadian economy, but there's still a few weeks of uncertainty to cope with.
Well, we'll keep the positivism of your comment, and thank you once again. Thank you all for joining us. We'll be back early March. Thank you. Have a good day.